Good morning, traders. This is Brad Matheny. Today is June 2nd. Coming to you talking about what I believe could become the largest threat to the U.S. and global economy in our foreseeable future, and that is commercial real estate loans and the possible implosion of debt related to commercial real estate in the U.S. banking system. Now, remember, I've been telling you guys that the markets are melting upward, and I see a very long term upward trend, likely lasting till 2030, maybe 2032 or 3. But this commercial real estate loan issue is potentially a pretty big issue. And I wanted to go over it with you from a standpoint of total real estate loans, which is this is where we're at, total real estate debt across all banks. This is all loans. We're up near 2.75 trillion, okay, all commercial banks, and the real estate default rate, which is starting to inch a little bit higher, you can see over here. This is going all the way back. Let's go all the way back here to 2000, and you can see how the default rate continued to move higher. Now remember, the Fed at this point in time didn't really have the ability to handle excessive crisis levels. So at this point under Greenspan, we had very limited capacity to handle crisis levels and we're still operating from a standpoint of, let's call it minor capital adjustments, capital risk liability capital adjustments. After the 2008-9 crash, the Fed then began to expand various forms of credit liability containment systems. And that's one of the reasons why we've had this continued success in growth in the economy from 2010-11 all the way up to where we're at right now. Now you can see in 2020 we had some large large acquisitions of commercial real estate, and that was because interest rates suddenly dropped and everybody was jumping into the commercial real estate business. You can see that delinquency rates are rather low still. Would be rather concerning if we continue to move higher. But I need you to understand that there's really a couple of things that come into my mind that say, number one, solutions. Okay, can the Fed originates special policies to mitigate commercial RE risks. Number two, banks could offer distressed borrowers interest-only solutions for 3 to 5 years. C, combination of Fed bank solutions could resolve biggest issues. And number 4, or D, let small amount of defaults happen while resolving and this would again be more stable borrowers with A to C solutions. So now, this is really what it comes down to, in my opinion. Borrowers. So why couldn't the banks do what is necessary to solve this solution by simply the Fed jumping in, creating special risk containment, and this is commercial RE, creating special containment scenarios Whereas the banks could offer interest only loans for those people who seem to be suitable, meaning having capital, run a quick check on them, make sure that they've got suitable capital to handle their risk containment level, maybe have something that requires a special deal with the borrowers that gives them an interest only scenario for 2 to 5 years, and pegs the interest rate maybe at 3.5, 4.5% for the next couple of years, letting them work themselves out of it, possibly giving up some sort of penalty and or extra fee on top of the loan that balloons out, say, 5 years later. Combination of Fed bank solutions could resolve the issues, and or let small amounts of defaults happen, which is a natural organic process, while attempting to resolve others. And again, that would only happen with the most suitable, meaning the lowest at-risk commercial borrowers wouldn't be savable. Those were the ones that couldn't really withstand a drawdown, while as the ones that have more capital and are better suited to withstanding a potential drawdown can take the risk on their own. The banks still service their loans, essentially service them on an interest-only basis, and the Fed could come in, easily with probably a 400 to 700 billion-dollar solution to assist the banks in the risk of some sort of a crisis. Now, secondarily, I want to point out that, and again, I'll do it here, banks insure loans against defaults. So again, understand that I'm just trying to fix this. So banks insure, I don't know why this is, okay, so E, thank you. Banks insure loans against defaults. So understand that, we're really looking at the idea that, banks could let these loans go straight into default. And, sure, it's going to take a hit. Yeah, the insurance companies are going to take a hit, maybe to the tune of, 1.6, 1.7, maybe $2 trillion. And that's going to definitely blow up the insurance industry. So we really don't want the banks to have too many loans going into default, which is why my solutions, A, B, C, D, would become more suitable as a containment of risk related to commercial real estate. But now we need to understand, lastly, how much derivative risk is there in the commercial sector. So let's take a look at something that shows us kind of where we're at with this derivative risk sector. So come over here if I can get it. This is a visual capitalist page showing as of, that's the date on this, March 11, 2024, so about 3 months ago, showing the banks how much risk they have, how much total loan capacity they have in commercial real estate going back in March. So understand, Wells Fargo has 684 billion. Citigroup has 945 billion. Okay, look at it this way, guys. Right there, you're talking 1.5 trillion dollars. Sorry, that's in total. That's their total. My bad. This is their total assets. They've got 145 billion, 37 billion, 76 billion, 171 billion. These are the four biggest. So total that up real quick. So 171, 145, that puts us at 220, 320, sorry. This puts us at 400 billion, and this puts us at, I'm just doing rough math, this puts us about 440 billion. So approximately, if you go down and add everybody up, you're probably talking about 600 to 700 billion dollars in total capital exposure related to the commercial real estate market. Now, derivatives could be, 3 or 4 or 5 times that. So you could be talking 3 trillion, 2.6 to 3 trillion or more in derivatives market. Now, this would also understand that a continued decline in commercial real estate would prompt two things. Number one, a resolution to how to roll this real estate into alternate use capacity, which we desperately need alternate use capacity in the form of, reasonable housing, reasonable apartments or condos. We desperately need the ability to support our elderly. We need to be able to provide means for them to be able to secure health care facilities, elderly care facilities, and not only that, just we could help our own people by providing them with, even a 600 square foot small mini apartment for a lot of these people would give them a job and a potential to potentially grow. There's a lot of things that could be done with this should the government come in or the Fed come in through some special process that acquires these commercial real estate properties and makes special amends to industry to go out and convert the property into suitable solutions for the most at-risk people in our society versus leaving them in their cars or in their street. I mean, I'm out here in Southern California, and I see people living on the streets or in their cars almost all the time in fairly affluent areas. It's just so expensive that someone living on a $1,400 a month Social Security just has no chance of surviving out here, unless it's in a cardboard box and, they're stealing internet from someone. So it comes down to the fact that the biggest risk we have in the U.S. economy right now is this commercial real estate. And when we look at the data, okay, where are we? So we'll move this out of the way. And where are we going all the way back? Let's take a look at this long term. Massive growth in commercial real estate loans. This is really tremendous since, say 2000. Actually, we could say since 94 here. We've got a value of 577 billion compared to 2.75 trillion right now. Has this been super inflated? Yes. How much is the price of commercial real estate value? Well, as far as I understand it, it's dropped 30 or 40%, and there's a lot of worry about banks mark to market this debt related to potential bank collapse. But remember, mark to market values means they've given a loan for a property, let's call it 400 million, and now it's worth 175 million. So the borrower really takes the risk, but the bank is holding the risk if the borrower defaults. So again, the solutions that I propose are designed to help us understand that and I believe the Fed is totally on top of this. I believe they're well aware of what's going on. I believe the banks are well aware of what's going on. And I believe there's already some contingency measure in place to attempt to prevent this from happening on a large scale basis. And I'm again, I don't have any inside information about this, but I'm pretty damn sure that the Fed is already aware of this. So the idea here is a combination of A, B, C, D could be put into place very quickly to resolve some of these problems and move forward with the ability to move these distressed properties away from risk and liability issues. Now, this is going to be held over our heads until this actually clears up as a potential black swan type of event that could unfold in the markets. And yes, it could. But again, the whole idea that I want to put before you is that we have the capacity to resolve this as long as this doesn't start to unfold in one big block. We cannot see, say, half of these loans start to really collapse overnight. That would be disastrous. And the reason why it would be disastrous is because the Fed would have to come up with, and the banks, potentially $3 trillion of immediate funding to solve this potential process. Yet, if the banks and the Fed took processes over the next 12 months to mitigate these issues, as I'm suggesting here, I would feel a lot more confident that this issue will not come suddenly bearing down on us. So be aware that this is the one biggest issue we have in the U.S. market and in the global markets, and that is a commercial real estate default block collapse happening because of some massive sector decline or credit risk or global banking disruption. And again, we need to be aware of it. This is the one risk that I think could come in and bite us in the rear end, but I think that we have the ability to solve it, and I think we need to start pushing to solve this relatively quickly before it does bite us in the rear end. So again, I think the Fed's going to keep everything running. I think they have a contingency plan in place. I don't believe this is much of an issue yet, but it certainly is bubbling and could become a big issue in the immediate future. Just a little FYI, guys.